Hi everyone, I'm James Harte from LittlefishFX.com and thank you for joining me for this week's live market analysis session. So in these weekly sessions, what we do is look over the major currency markets, talking about the key fundamental developments, assessing the technicals with a view to identifying directional bias and trading opportunities for the week ahead. So as ever, if you have any questions during the presentation, please just write them in the chat function and I'll stop periodically to answer them. Okay, so kicking off first of all, as always, looking at the US dollar index. And obviously the main story here is the sharp downshift in rate hike expectations that we've had in the wake of last week's shockingly low non-farm payrolls print. So markets were expecting a 160 to 170,000 print last week, but actually we only saw 38,000 new jobs added in May. So this was well below the expected number, and consequently we saw the USD sold heavily on this news. Now obviously a great deal of the positive Fed commentary that we've had in recent weeks, including the April FOMC minutes with their hawkish slant, and also comments by Fed Chair Yellen, have all noted the need for Q2 data to improve to facilitate a rate hike in the coming months, specifically labor market conditions and inflation data. So this significant disappointment in terms of labor market conditions has been taken as a strong sign by the market that a June hike is off the table. This sentiment was compounded on Monday when Fed Chair Yellen was speaking again, because although she reiterated that the Fed was still confident in seeing further rate hikes this year, she actually refrained from referencing specific timing. So she didn't use the phrase "in the coming months," which she had done just a week prior. So USD bulls pretty much reading the writing on the wall at the moment, and we're seeing a continued unwind in USD positions. So looking at the technical chart, you can see last week we were at this level, okay? So we traded up into this key resistance level around the 95, 91 mark, just above the 38.2% retracement. So into the low close here, we also had this bearish trendline resistance coming in. So we traded up into that level, we held at that level, and obviously in the wake of that disappointing NFP print, you can see that we've cascaded lower. And the move lower has been a particularly brutal one. So I was talking last week ahead of the NFPs that we might see this area, this 94 level, work as key short-term support for the US dollar, expecting that we would still get a move higher over the month. However, in the wake of that shocking NFP print, you can see that the market has blown straight through that level. So we stalled at that short-term support initially. However, we failed there and we're currently trading below that level. So for now, driven by heavy bearish sentiment, USD is continuing to trade lower, and the next level that we need to be thinking about now is a test of this big 93.14 level, which is the big low. So if we go back out to our monthly chart quickly, just to get some perspective on this move, you can see that for now, what we're actually seeing is a retracement within that large bullish engulfing candle which we saw form last month. So for now, price action is testing this big key structural support, okay? So we're testing the lows of last year. We put in this huge bullish engulfing candle, so that's a key reversal candlestick. And we were anticipating that price was going to trade higher. However, what we have seen, and what we actually allowed some scope for those of you who are around for the first sessions, you'll remember that although I noted the likelihood, or the expectation rather, that the US dollar was going to trade higher over the medium term, I did allow scope for some bearish retracement, which we often see after such a strong monthly close like this. So for now, all we're seeing is a retracement of this key reversal candle. So whilst we hold within this candle, I'll still be looking for US dollar to find some support and then ultimately to trade higher again. However, the key juncture which we need to keep an eye on is obviously this 91.88 low. So if price breaks down below that low, then obviously sentiment has taken a significant shift and we can expect that we are going to trade lower. So really for now, it's about treading cautiously and waiting to see where we get to in the wake of the June FOMC meeting. So the period after the non-farm payrolls print is usually quite a low volume period for markets, and now it's all about waiting for that June FOMC meeting. So if we don't get a move in June, as markets are expecting is the case, then what we're going to need to see for continued dollar upside is a clear signal that July is a contender. Now, if we don't get a clear signal that July is on the table, then we can expect the US dollar to continue to trade lower. And I will be looking for a break of that 91.88 level to signal continued downside. In the short term, you can see that we still have a potential inverse head and shoulders pattern in play here. So although we've run a little bit deeper than the initial support level we were looking at, we're still holding at the level of this potential left shoulder. So if price action can reverse higher from here, potentially on the back of that June FOMC meeting, then I'll be looking for price to clear this 95.90 high to signal a breakout and a trade to the top side. So obviously these levels are quite away from the market at the moment, and as I say, expecting this low momentum, low volume period to continue in the short term up until that June FOMC meeting, which is going to be of paramount importance for US dollar direction over the summer. So really key to keep an eye on that. And as I say, in the meantime, not really expecting much in the way of clear directional moves. If this continues to the downside here, I'll be looking for the 93.14 area to provide some support. So looking to the FX majors charts then to see how this analysis translates. So looking first of all at the euro dollar. Obviously, just the inverse of what we were looking at with the dollar index. So we've seen price rip higher on that dollar cascade. Now, we were actually looking last week at price bouncing either from what was then the current low around this 111 area, signaled by this bullish engulfing candle on the daily, or actually for price to make one final push lower and test that rising trend line support. But we were anticipating that we were going to get a move higher. And the two areas that we were looking at, my analysis at the time was suggesting that price was going to find resistance at either the 112.20 level or deeper at this 113.12 level. So you can see that ahead of the NFPs, we did in fact trade up and find some short-term resistance at that 112.20 level. We got a 70 pip move lower, so a decent short-term reaction there for intraday traders who are active at the level. But the level that I was really watching for a medium-term resumption of the euro downtrend was going to be this 113.12 level. However, on the back of the NFP print, you can see that we just blew straight through that level. So this really highlights the importance of waiting for these moves to settle down. Okay, I don't like to position just ahead of the NFP or just after it, especially where we get such a disparity between the expected number and the actual number, because it's very hard to tell when these moves are going to end. So we saw price rip above that 13.12 level. We've actually retested the underside of that broken short-term bullish trend line. So when we first started these sessions just over a month ago, price was trading just above that level. We since broke down through it. We've now traded back up and we're retesting that broken bullish trend line from the underside. So this is a clear short-term price pivot for the euro. You can see that we've traded back up into this area of previous highs. So we've got some decent resistance here. And then actually just above this level at the 14.20 level, you can see that we've got even stronger resistance. So if we zoom out onto the daily charts, you can see that this 14.20s level, so I'll just change the color there to make that clearer. Okay, so that 14.20s level, you can see looking back over the last year and a half, this has been a really important pivot for the euro. And you can see that price action has been capped there several times. So over the last year, we've had more than a handful of key bearish reversals occur at that level. Now, typically, what we've seen as price action has traded up into that level over the last year and a half is a prevalence of dovish ECB rhetoric. Though now, with the ECB noting that they aren't specifically targeting a weaker exchange rate and are instead focusing on fueling domestic demand, perhaps there is some scope for euro dollar to move above this level. So if the dollar slide does continue, and if that June FOMC meeting fails to convince bulls or reassure them that July is still a live possibility, then we could see the euro break above this level and trade to the top side. Now, in terms of fundamentals from the euro perspective, then we had the ECB meeting last week, which was pretty much a non-event. So the ECB kept policy at current levels, that we did actually see an upward revision to both inflation and growth forecasts for the year ahead. So this is currently supporting euro sentiment. Obviously, the ECB's famous line of reiterating their willingness to act if needed was included. So not much change in the picture there besides the upward revisions to growth and inflation forecasts. And as I say, euro seemingly well supported on the back of that. So with USD rate hike expectations unwinding, the ECB remaining on hold, and that revision upward to inflation and growth forecast, we could see the euro continue to break higher here. So I'll be watching that 14.26 level as a key pivot, and above there we've got a little bit of open water really up until the next key level at 15.23, which is the high close here from the year-to-date highs. And then above that level, the major level which we're going to be looking at is this 116 area. So it was the high close of last year's highs, and it was the high print this year. So big double top level there. And if market can get above there, okay, so this is going to signal a clear breakout to the top side. If price can sustain and move beyond there, then the level which I'm sort of quietly keeping an eye on is actually this gap fill level at around 119.90s. If I just zoom in here, you can see, so that last gap that we had before the major decline at the end of 2014 and into early 2015. So if price can break above this base, then I'll be looking to target and move up into that 119 area. So obviously for now, we're talking about a level that's 700 pips above market. So that's quite optimistic, and a lot can change. I'm just scoping out these levels so you've got an idea of the medium term levels that we'll be taking a look at, okay? You can see we have another good resistance level here at this previous high, so last year's high, coming in with those broken lows. So for now, looking at the euro dollar, again, suffering from lack of momentum in the market, bit of directionless action. We've got a potential head and shoulders pattern here. So if market does hold at current levels and start to trade lower, I'd be looking to trade a break of this structural low at the 108 level and a break of that rising trend line support, targeting a move down into this 108.16s area, which you can see is a big structural support level for the euro, 108.20s. So that's the play with the euro dollar that I'm looking at. And again, in the meantime, we're simply stuck in this range bound position, okay? If you look at the price we're currently trading, this is the price that we were trading roughly 1 month into the open this year. So relatively directionless moves at the moment, just waiting for some resolution here, and that's likely to come on the back of the June FOMC meeting. So moving on and looking at cable. Cable, not really a huge amount to update on since last week, okay? The Brexit rodeo continues with price action still neurotically bound to the latest polling results. So yesterday we saw a wild move in sterling dollar. So for those of you who didn't see it, okay, we had this 180 pip spike, which actually occurred in less than 60 seconds. And that was reportedly due to a fat finger trade, so an error trade, an erroneous trade. Now, a lot of banks at the moment are noting that liquidity is very thin in sterling, and so they're expecting erratic moves to continue ahead of the UK referendum on June 23rd. So really, it's best to approach this chart from a safe distance and stay away from any intraday trading at the moment, as price action, as you can see here, very directionless, very choppy, very erratic moves. So going out onto the daily charts then, we can see that the clear markers that we have are this corrective bullish channel to the medium and longer term bearish trend. So looking at that from a purely technical perspective, we would expect for this period of price action to break lower and signal a resumption of this bearish move. Now, we also have this contracting triangle, which again, if we work on the basis that market leading up to the formation of this structure was moving in a bearish phase, then we would expect resolution to see a downside move. So we came bearish into that move, we formed this period of compression and correction, we'd then be looking for this move to resume to the downside. However, a lot going on with sterling at the moment. Obviously, the EU-UK referendum is having a major impact on market sentiment. So depending on what happens there, is going to be the key driver in which way this structure breaks. And obviously we've got some really good levels to take a look at. So if I just get rid of some of these older lines. So again, approaching this from a safe distance, you can see that we have this clear band of structural resistance around 147.40s and the bearish trendline resistance. So a break above that level signals a continuation to the top side. Then to the downside, you can see we've got a similar setup here. So we've got these two big lows coming in at around 143.50s, and then we've got the rising trend line just below. So a break of this key structural resistance and this key trendline resistance signals topside breakout. A break of that key structural support and that rising trendline support signals a breakdown. So from beyond the 43.50s mark, we could target and move 270 pips lower into the 140.60 area where we have this key structural support again. And then above here, really we're targeting a move back up into this area, the 149.40 area. So about 200 to 300 pips either side of those levels. So we've got some decent breakout plays. But again, for now, whilst momentum is so dried up, whilst there's no direction, I'm really not looking to get involved in this. And so it's really going to be the back of that June referendum that we see any clear moves made. Dollar yen then, dollar yen, another chart which is clearly bearing the brunt, excuse me, clearly bearing the brunt of this dollar slide. So we were looking last week at price action having challenged that big 111 area resistance, which we've been noting over these recent sessions. We clearly broke down from that on the back of that weak NFP print. And you'll remember that the level that we were looking at as potential support was going to be this level here, so the 107.90s. And what I was anticipating is that we were going to get an inverse head and shoulders form, find some support at the test of this key structural support, and also the retest of this broken bearish trend line. And then if we got any bullish price action there, I was looking to position for a move higher. However, on the back of that brutal post NFP slide, we've seen price action blow through that level, again highlighting why you really need to let these moves play out before looking to get involved on the back of major news events like that, especially where we get such a surprise reading. So we've since broken down below that key support level, and you can see that the price has tested that level from the underside and it's held as resistance. So this is now the key short-term price pivot in dollar yen. So whilst we hold below this level, I'm expecting a challenge of the year-to-date lows. If we can make it back above that level, then we can start to think about moving higher to 111 again. So again, momentum is dried up, direction is lacking. Ahead of the June FOMC meeting, I'm not really expecting much in the way of clear moves here, and really all I think we'll get is a continued rotation within this range, with 111 acting as resistance and this lower 106 to 105 band acting as support. So the Bank of Japan are out of the limelight a little bit now. The sales tax increase in Japan was delayed from 2017 to 2019 to avoid the risk of causing any further damage to the economy. So Japanese yen was supported a bit on the back of that news. However, I think we can expect that if these moves continue, so if we do get a continued surge in Japanese yen strength, then the Bank of Japan are going to be back on the wires, and we're going to have to think about the possibility of intervention there. A lot of traders are wary of playing the Japanese yen to the long side, specifically because of this reason. So things are quiet for now. But if we do get this dovish June FOMC meeting, and if the dollar does continue to slide and the Japanese yen picks up pace, then we'll need to focus on being wary of the BOJ once again. So for now, it's a question of waiting to see where we get to after that June FOMC meeting. And this is really the case across the board. So we could still have that inverse head and shoulders pattern in play on the dollar yen. Obviously, we'd have more of a sloping neckline. And so really the breakout point for the dollar yen is back above this high here, the 111.90s high. And to the downside, it's a break of this 105.40s level. Obviously, I like to be careful when we make a break of an individual low or high point, as often we get a false move and then simply a double bottom occur. So really to trade this, I'd be looking for price to break down below it and then trade back up and retest this underside. So obviously we're getting some decent support form at this level here. So ideally for price to break down, then retest that, and then I'd look to get involved on the break through that initial low. So not much to do here ahead of the June FOMC meeting. Be very cautious about getting involved in any breaks in the meantime, as with momentum lacking, we're likely to see some rotation in these markets, not a lot in the way of clear moves. Then, and one market where we are certainly getting clear moves. So you'll remember that I was actually long from 98.10. This was a trade alert that we had on the website. I was holding it ahead of the NFPs. It was up around 120, 130 pips, expecting that we were still going to get a move higher, expecting that that NFP print was going to clear the 160K expected number. Obviously, that wasn't the case, and we got stopped at break even on that trade, which is the case sometimes. You know, holding a position ahead of data like that has obvious implications. The risk is both ways, but I was expecting that we were going to get a beat there. So disappointed on that trade, but wait for a repositioning chance. So we broke down from that area. We were noting this breakout area was likely to act as support. However, again, the NFP move was brutal. We broke down through that level. We broke back beneath that broken bearish trendline resistance. And so we've now reclaimed that bearish trend line, and we've broken through the level which we were also monitoring for potential support, which was this really nice structural level here. You can see we had support, support, a break, resistance, a break, support, a break, support, support. So now that we've got back down below that level and we've broken down below the 61.8% retracement, the quite clear we're looking for a continuation lower to target and move into this 94, 96 area, and really a retest of this 96.80s level would provide a good opportunity for short. So if we do get any short-term bounce, which we might actually see occur from this level here, so if we do get any sort of short-term bounce, depending on where it comes from, I'd be looking for a retest of that area. So in line with this broken structural support, in line with the bearish trend line again, I'd be looking for that area to provide a decent level to set shorts, targeting a move back down into these lows. Okay, the dollar CAD then, and it's a very similar story. We traded up into our initial target on that breakout move. So we broke out above the 130s highs here. Let me just change that color again. Okay, so not quite, but close enough. So we broke out above that level, the 130 level, traded up into our first target. We were capped there, we traded lower, found support, traded back up. We got a failed double top here and rolled over on the back of the NFP. So I actually had quite a nice trade in the dollar CAD this week. It was a break of the 120.10 support level here. So I traded the breakdown from there, targeting a move down into this 127.70 support, where I actually banked on that trade. So obviously looking at the chart now, you can see that I was out a little prematurely on that. But this was just an intraday trade. I was expecting that we were going to get a break at that level. And on these intraday trades, I just like to trade them from level to level. So I'm not looking to hold for any huge targets. I'm just looking to play them from level to level. So I had a 60 pip stop and I banked 120 pips on that trade. So perfectly happy with that. Obviously has subsequently rolled over. So the target now for this trade, for those who are still short this market rather, is a move down into the 78.6% retracement, which is the next key Fibonacci level. So the move from lows to highs, you can see that we broke down through the short-term rising trend line here. We had that head and shoulders, so this was a break of the neckline. We broke down to this last key structural support. We've broken down through this next structural support. And so in terms of structure, there really isn't anything until down here. We've got a small ledge of prior support there, which in sync with the 78.6% retracement could provide a short-term bounce. But really, again, I'm looking for this market to continue down to lows here. And so if we do get a bounce at this level, I'll be looking for a break and a continuation lower. So not looking for anything to the top side in this market. Head and shoulders signals that we're going to trade back down into these lows. So really, it's just about finding good levels to get involved to the short side. So obviously, if we get a retest of any of these broken resistance levels, these could be decent areas to set shorts. But the way price is moving currently, it looks like we're just going to continue in this fashion of making only very minor consolidation before continuing to the downside. Aussie dollar then, and another great chart that you can see is really welcoming this collapse in the US dollar. So we noted last week that we had this clear resistance level at 73.80 to 73.30s to 73.80s level, which was these two big prior highs last year. We've since broken out above that level and we're forging higher ground. So we had the RBA meeting this week with the RBA keeping policy at current levels rather, but actually there was a little change in tone, which has given the Aussie dollar some support. So we had a slightly less dovish than expected statement, with Governor Stevens noting that keeping rates at current levels would be consistent with sustainable growth in the economy and inflation returning to target over time. So this comes on the back of a raft of positive Australian data recently, with a big beat in Q1 GDP, the headline figure. So the Australian dollar is supported for now and heading higher. But one level that I am going to be keeping an eye on, which we could see some decent selling interest emerge at, is this level here. So this 74.97. So we'll call it 75. Okay, you can see we've got this nice ledge of previous broken lows, so good structural resistance. We've also got solid fib confluence there with a 50% retracement from the year-to-date highs coming in at that level. And we've also got added symmetry confluence, with this last push into highs being of equal length as that the distance between this low and this high. So nice technical confluence here. We've got the symmetry move, the fib confluence, and the structural resistance. So this could be an area where if we get some price action candles signaling reversal, I'd look to get involved to the short side, probably only targeting a move back down into this initial area, okay? This 73.80s to 73.30s, which I'd expect to provide some short-term support. And then from there, it would either be a question of moving lower in this fashion or moving higher in this fashion. So really going to come down to what happens with the June FOMC meeting as to which way we break here in the medium term. For now, obviously, we're simply rotating within this range. So we've got quite a nice symmetrical range here with the high at 78.26. That color is a little bit difficult to see. That's no better. There we go. Okay, so the high coming at 78.26. The low down here at 68.70. So you can see we've got this nice symmetrical move in the market. The clear pivot being this 73.80s to 73.30s level. So we're keeping an eye on how price performs if we retest that level in the short term. So for now, keeping an eye on price as it tests the 75 level. Obviously, if we get above there, then this is the clear pivot for a breakout. So if we get above there, we can look for longs targeting a move higher. And finally, then, the Kiwi dollar. So you remember last week that we noted the possibility of this breakout higher in the Kiwi above the level which we marked was the 68.45s level. So I noted this chart as being very congested. We lost a lot of momentum on this initial bearish move as we traded back into this zone. You can see that we had a horrendous period of chop over the first months of this year. And once price action traded back into this area, it just seemed to really not like it. We got stuck. We weren't getting any clear moves to the downside. And we had this clear level in the market here at 68.45s. These prior highs, and so I was noting that we could see a breakout above that level, which we did indeed see. We've since broken back above the rising trend line support from year-to-date lows, and so whilst we hold above here, I'm still anticipating that we're going to move higher. So I noted that it really felt like the open water in this chart, the room to move was to the top side, and that this retest of this base was going to provide an exhaustion and a resumption to the top side. So for now, you can see that's what's happening. And we've got the Reserve Bank of New Zealand meeting later tonight. So won't be looking to get involved ahead of that. So I have stayed out of these breakout moves for now. But the next clear level, the next key level that I'll be looking to make a trade based upon is this 70.60 level here. So the big double top level at the year-to-date highs. So if the RBNZ refrain from cutting rates further. So at the moment, the majority of analysts are actually expecting that they are going to reduce rates further. However, if they do refrain from cutting rates, this could provide the clear catalyst for a move higher. And I'll be looking to position on a break above this 70.60 level, targeting a move up into this level ultimately. So if these big weekly lows from 2015. This would be the next main level that I'd be looking to play. So above 70.60, we've got about 200 pips worth of room up to the next key resistance level. So I'll certainly be keeping an eye on that. And you can see from where we're trading currently, that we've got decent support now in the market. So if we do trade back down lower from here, we've got this level at 68.40s, which could provide decent support. So we might see a move that looks like this. A move down lower initially from a retest of that level, stall at that level, and then a move higher. Alternatively, we simply break out above this level and either retest and move higher or just continue higher in a straight line. So that's what I'm looking at with the Kiwi, obviously depending on what happens with the RBNZ. If they do cut rates or if they do use particularly dovish language, we could see a move back lower, in which case I'm not really looking to do anything unless we make a break of this level. So if we make a bigger double top here, and then move down and get some good momentum, take out this 66.70 level, I'll be looking to play that to the short side, targeting move down into this mid 65 level. So those are the levels I'm monitoring for now in the FX markets. Again, the big theme here is just what's going to happen with this June FOMC meeting. So I'm not expecting that we're going to get any move on rates, but the key is going to be whether or not the Fed signals that July is a strong possibility. And if the market doesn't get a sense that there is a likelihood of a July move, then we're going to see this US dollar slide continue, and we're going to get a lot of breakouts on these charts. So definitely some big levels to keep an eye on, apart from cable, which, as I say, is really suffering from its own situation at the moment with regards to the Brexit situation. So I hope you've enjoyed that and got those levels marked clearly. I look forward to catching up with you next week. In the meantime, please check out the website, www.littlefishfx.com. You can check out all of our great education material, as well as the Forex Master Course and our daily trade alerts, which are already up 300 pips in June. We've actually got an exclusive webinar coming next week with one of our top traders who's going to be talking about his particular trading methods. So for more information on that, head to the website and check that out. In the meantime, best of luck, take care, and I'll catch you all next week.